Good evening, everybody. It's great to be here to discuss credit. And what we're going to do is kind of just start off with the basic credit information and scoring. The most important thing about credit, everybody always wants to know, what is my 3-digit score? Because everything revolves around that. You have your interest rate. You have whether or not you're going to get approved for a loan, for a car, for a house, rent an apartment. All kinds of things go into that credit score. So it's very important to understand, how that credit score is derived, and also to give you some best practices on how to make sure your credit score is as high as possible. So we can go to the next slide. So where does scoring come from? That's one of the things we're going to touch on tonight, all the intricacies of where it comes from, and most importantly, how are you going to be able to improve your particular credit score? Now, one of the things I want to highlight are the 3 national repositories. So this is where all of your data is stored. And I want to make sure everyone is familiar with those names, Equifax, Experian, and TransUnion, because again, number one, that's where everything is stored, and that's where all your creditors are going to report every single month to those repositories. And what they look for is how they associate your credit file with you, or what's called PII information, and that's personally identifiable information. And there's 4 pieces of that information. It's your name, your address, your social security number, and your date of birth. So what would typically happen is sometimes if somebody moves or somebody changes their name, there may be a mismatch there on the credit file. So you want to make sure you know how to get in touch with the bureaus if you ever do need to update your name or your address and it hasn't been done already for you. So again, very, very important to have that as a tool for you. The repositories are 3 separate companies. They're competitors. They do not share information with each other. They only get it directly from your creditors, credit cards, your auto loans, mortgage companies, things of that nature. So what happens is they get all this information typically on a monthly basis from all your creditors, and then they store it. What's interesting is they don't all report it at the same time. And what typically happens is, let's just say your Capital One credit card. Well, you may send all your information to all 3 bureaus today, but Equifax may update it tomorrow. TransUnion may update it next Tuesday, and Experian may batch it over the weekend sometimes. So they're all moving targets and they're all doing it at different times. So that's why sometimes when you look at your credit report, it doesn't sync up exactly, because maybe Capital One reported it yesterday, but Equifax hasn't updated yet. And that's why Equifax is going to look a little bit different. So it's important to understand, they are 3 different moving targets at any point in time. And they all the data sets can be different. So, again, very, very important. One of the common questions that I always get is, well, okay, if it's Capital One, when do they send it in every single month? And typically there is no guaranteed answer to that. But after a while, once you start to watch your credit report, you can kind of get a general idea of roughly the time of the month that each creditor does send it in. And then you can make estimates on that. But there's no ironclad rule that they always have to report on the 1st or the 20th or anything like that. It's pretty much going to ebb and flow according to the creditor and when the bureaus update that information. So in the credit world, we have good information and we have derogatory information. Now, the good information can stay on forever. We don't really care about that. That's only going to help you out. So that's great. Where things get interesting is when there's derogatory information. And there's the Fair Credit Reporting Act is an act passed by the federal government that gives rules on how derogatory information can be reported and for how long it can be reported on a consumer's credit file. So as you can see there, every single item on there that's is a derogatory item, and there's a statute of limitations, if you will, on how long that can show up on your credit report. So most of them are 7 years, with the exception of the Chapter 7 bankruptcy, which will stay on your credit report for 10 years. And that's from basically the date of the activity when it happens. So if you had an event, let's just say 6.5 years ago, then you can predict and say, okay, I know that in 6 months, when this derogatory information falls off, then my credit score will go up. And we'll talk later on about how you can estimate that a little bit more. But just in a general rule, it's important to kind of know those types of things. So the next one, this 3-digit score that everybody's concerned about, what is it? And the definition of what it's trying to do, it's trying to predict whether an applicant for a loan will have a 90-day late payment at any point in the next 24 months. That's the goal of what it's trying to predict. And what it does, it uses a statistical method going in, looking at all of your trade line information by using a scorecard. And it uses that to make all thousands and thousands of calculations in the background. And again, we'll kind of go over the nuts and bolts of all that in a few slides, but right now it's like just the general overview is that's how it's doing it. It's using that as a scorecard. Now on a sample credit report, I'm sure some of you have gone on and gotten consumer credit files before. Maybe you've worked with your lender and they've shared a credit report with you, but in a general sense, what you're going to see is some header information, and that's going to show the bureau that's giving the information. You're going to have the name that they have on file with, that associates with you, your social security number, and then your credit score. And then right underneath that, all the bureaus give the 4 most powerful reasons why your credit score is what it is. So in this particular case, this person has a lower credit score at 655 than the high limit because they have too many high revolving accounts. They've had too many inquiries in the last month, too many accounts with balances, and they haven't really had a whole lot of accounts that have seasoned. So those are the reasons why the model is saying, hey, this one is in particular is a 655. And that's helpful for consumers because they can look at those and say, wait a minute, let me go look at my balances, or maybe I have been having my credit report pulled too many times. So very good information there for you to be aware of. Okay, so what is not in a credit score? We're going to get to the stuff that's in it in a minute, but here are the things that have no bearing on credit score. And one of the ones that's pretty interesting is toward the end, which is interest rate. So a lot of people think that the interest rate does have a bearing on the credit score itself, and it does not. It doesn't matter whether your interest rate is 0% or 30%, doesn't matter. It really goes to your payment history and other things. So that doesn't matter. It also doesn't matter about your employment or how much money you make. That does not have any bearing at all into what your credit score is. So each bureau has their own credit score. And inside of each credit score, there are different versions of the credit score. And you can think of it like versions of software on your computer or updates on your phone. There's so many different ones, and they're all looking for different things. There are consumer versions, which is where you can go online and get your free version. There are insurance scores the insurance companies will use. There are mortgage credit scores when you're buying a home, and various other ones. Vantage Score is a big popular one right now that's out there on the consumer side. So all these different scores exist, but to give you like a rough idea of the ranges of them, they pretty much will range from the 350, high 300s up until the mid 8s up to 950, depending on which version of the credit score you're looking at. That's kind of a general range just to be familiar with. I mean, you're not going to see 150, you're not going to see a 3,000. It's just, those are the ranges right there. The higher the score, the better credit risk you are to a lender. Now, this is where it gets really interesting. And this is one of my favorite slides because when, the investors that are investing for mortgages or for auto loans or even credit cards, they all have their pile of money that they want to lend. And they have different thresholds. And I'm sure some of you may have heard, hey, I need to have a 720 or a 680 or a 640 credit score to, number one, qualify or to get a better interest rate. And this is where that comes from. And when they go back through millions of credit files, they've come up with these guidelines and they say, okay, if we loan to somebody with a below a 600 credit score, 1 out of 8 of those is going to have a problem, a default. Conversely, if you have an 800 plus credit score, we have 1,292 loans before we have 1 that's going to have a problem. So what happens is they look at this and they say, okay, we're going to draw a line, and we're very comfortable with if somebody has below a 620, well, we're comfortable with giving them maybe a 10% interest rate on their auto loan. But if someone has 800, maybe we're comfortable with giving them a 3% interest rate on the car. So as you can see, all these cutoffs are just, made by the investors. And you can see that if you need a 640 and you're sitting at 639, that one extra point could maybe cost you getting the house or the car, or maybe you pay 3 or 4% more in interest just because you're missing that one point. So that's why it's so critical to understand how we can make sure you're getting every single point that you can on your credit score. So the models that make up the credit score, they're proprietary. So they don't go out and actively say, hey, this is our exact formula. But what they do is they give some guidance and they give some general guidelines, which we're going to go over in a little bit about how the scores are made up. And some companies have reverse engineered the process. So some credit card companies will, you can just click the button on your app and it can give you a prediction of, hey, what will happen if you pay down a credit card or open a new one? So there's all kind of predictive analytics out there right now that can help simulate what will happen, and they're pretty accurate. So you can know probably with a 95 or 98% confidence level that this action is going to help you or this other action may hurt you. But the scores only use the raw data that the repositories have. So if they have erroneous information or information that's not right, then of course, it's only going to be as good as the information they have. And there's going to be some mechanisms that I'll go over later on about how you can help get those corrected and make sure that your picture is accurate. Okay, so here's basically the blueprint of all the different items that make up your credit score. And this is no different than in school where a teacher has a particular grading system and they say, hey, these are all the different components of your grade for the year. And in the credit world, it's the same thing. So we have 35% is the biggest chunk of your credit score, and that comes from your past payment history. The next biggest are your balances. Then the credit history, 15, and then the last two, the types of credit and the inquiries are both 10%. So we're going to kind of go through each one of them here. And the first one is going to be the payment history. So think of it like almost like a fire. When you're standing right close to a fire, you're going to feel the most heat. As you start to move away from that fire, the heat gets less. Same thing is true with derogatory information on your credit report. It's all about timing. So what happens is, let's just say I have my first late payment on my credit card right now in this first month. Well, it's going to hit me really hard for the first 6 months. And I'm making up numbers, but let's just say my credit score was 700 and I have my first late payment. So it docks me 100 points. So now my credit score is 600 points. So for that first 6 months, I'm getting hit the hardest. After 6 months, though, it's going to start to heal itself a little bit. It's not going to be as intense. So my credit score is going to actually improve because that particular derogatory item is aging out. It's still going to count. So maybe not the 100 points. Maybe I'm now only going to take a 60 or 70 point hit for that from month 7 to 23. And then at 2 years, and 2 years is a really critical point in the credit world, because then it'll kind of flip over to like an old problem. And then the significance is going to go down quite a bit. So maybe after 24 months, until it falls off, I may only take a 20 or 25 point hit on that, where I was getting hit the full 100 for the first 6 months. So again, why that's important is that if you're looking at someone's credit and they had an event, 22 months ago, then we can reasonably predict that, hey, when this ages out again in 2 months and it becomes 2 years old, this credit score is going to go up. And that's very useful when you're planning to, rent an apartment, buy a house, buy a car, whatever. So that's kind of the nuts and bolts of the past payment history. And at this point, I want to stop and just see if anybody has any questions. And I think we do have a few questions there. Okay.
All right, let's see. Okay, Pat Knight. Hey, Pat. Let's see. Is her mic activated or shall I read it? I can't see. I only see David. Okay, so I'll read it. Hey, Pat. You got the floor.
Well,
okay.
Hi. I was just asking because if you have a too high of a balance, your credit score suffers, and if you have too low of a balance, or you have money that a lot of money that you can use, doesn't your credit suffer for that as well? So what's a happy medium?
Yeah, and that's a great question. And in the next slide, we're going to get into that. That's
Oh, okay.
an awesome question. And that's going to really be the nuts and bolts of the next slide. So if you can, we just hold that. And just, if there are any other questions, we can address those now. And if not, we'll go to Pat's question in the next slide.
Okay, I don't see any others, so please proceed. And this is awesome. Before you go, David, I don't know about the rest of you guys, but I'm loving it. I had no idea. So I thought 719 was amazing, right? But 720 is 3 times more amazing than 719. I had no
That's
idea.
exactly right. Yes, that is exactly right. And it's crazy how, and again, these are all computers just spitting out numbers. So yeah, it's very important that one extra point can make a difference. And who knows, $30, $40 a month on a car loan, or a lot more than that on a mortgage. So very, very important to understand this. And before we go on to Pat's question, I want to say one more thing on this one. And that is, everything is time sensitive in the credit world. So we know that, hey, something that's brand new is going to count, against us pretty significantly. What a lot of people sometimes don't understand or pay attention to is that, let's just say we had an event that happened 4 years ago, and that we see this happen all the time, and we've forgotten about it, and it's just sitting there minding its own business, and the credit score's gone up because it's aging out. Well, all of a sudden, when somebody looks at a model home and they want to buy a house or whatever, they start getting really excited, and they say, hey, let me, oh my gosh, I remember I had a problem 3 or 4 years ago. Let me go and address that. And sometimes when you call a creditor that's been sitting there just minding its own business, and you stir it back up again, if you will, and say, hey, I know I owed you, $500. Let me go ahead and make a payment arrangement. Let's go ahead and reactivate this. Then a lot of times that derogatory data lapse activity will change. So instead of it being, November of 2017, now all of a sudden the creditor has changed it to where now it's November of 2021. The model says, oh, this is a brand new problem. So we have to be very careful about going in and disturbing accounts that have kind of aged out on their own. So you want to be very careful with that. And there's some tools that you can go to. Obviously, if you're working with Tidewater Home Funding, they have tools that can help predict that. If you're going to some other resources that I'll give at the end of the presentation, the annualcreditreport.com, you can kind of model those out and kind of see how you want to handle those on a one-off basis. But you want to be very careful about going in and disturbing items that have been sitting there minding their own business on a credit report. So I just wanted to add that last piece there.
Oh, that's awesome. Thank you.
Oh, sure. So the next slide is Pat's question here about the balances. And that was such a great question. And how it works is that the balances are very, very sensitive on revolving charge cards. So what that means is we're going to take mortgages, student loans, auto loans. Don't really care about those for the purposes of this slide and this discussion. This only impacts revolving charge cards. And how it does it is the models look at that as all about percentages. So if I have $1,000 credit limit on my card, then if it's paid off or paid, $15 or $20 balance, then that's great. I'm going to have the highest score possible. But as I start to put a balance on that credit card, different percentages will trigger a score to go down. So at 30%, I'm going to take a hit. At 50%, I'm going to take even bigger hit. Then at 70%, and then when it's maxed out or I go over my limit, I'm going to take a huge hit on that. So a good rule of thumb is to say, hey, in an ideal world, you want to have all your credit cards paid off down to zero, or $15, $20 is fine. Sometimes we see an advantage to having just a few dollars on a credit card as opposed to paying it to zero. But for purposes of this discussion, let's just say ideal world, keep them all at zero. If you can't do that, then have them all under 30%. If you can't do that, keep them all under 50%. You don't want to go and put all your balances on one card. And I know a lot of times it's very tempting to do that because a creditor may say, hey, we'll give you 0% interest. So somebody puts all their revolving debt on one card, that card's maxed out, the model doesn't like that, and you're going to take a hit on the credit score for that. So again, try to put them pay them all down and keep them as low as possible on the percentages. So that's, in a nutshell, how the balances work. And a lot of times, on some of these personal finance estimators, when you get your credit report, you can go in there and play around with it and say, what happens if I pay this credit card off? Then my score will go up or down, or whatever. You can play around with it. Those are very useful to do because, as we talked about earlier, if you can pay $50 of a balance down on a credit card and get 5 points, and that puts you over the threshold for a better interest rate, well, that's the best $50 you'll spend. So very, very important to know that. And I see Pat just in another question. A lot of companies will close your account if you do not have a balance for months. That is absolutely true, and that can have an impact. And that'll, again, another slide, we're going to talk more about how the timing works on how old accounts are and how they season. But absolutely. So one rule of thumb, and I'm going to touch on this a little bit later, but I'll say it now, is that it's very important to have your credit cards and to use them once a month. And it doesn't need to be anything crazy. I mean, you can just put a cup of coffee or a $5 worth of gas or whatever. Just put something on it each month and pay it off. And if you do that, then you'll keep it active, you'll keep it going. You want to be very, very careful. You don't just not use the cards, because sometimes if they do close it and later on you decide to go back in and open it, they may want to repull your credit again. So there's all kinds of other issues with that. But that is a really, really good question there. Okay. We can go to the next slide. Okay. So the revolving balances that I talked about, again, are just for revolving charge cards. And, years ago, home equity loan lines and revolving lines of credit were a big deal. And some of you may have them associated with a business or a home or something. And what happened was the model kind of got into a little bit of confusion, because some people had, loans that were attached to a house or a business, and they were large amounts, over $25,000. So what happened was the model kind of said, hey, if something's over $25,000 on a revolving line, then we're going to treat that a little bit differently. So before paying down a large balance like that, and they're not very common, but if you do happen to find one of those, you want to make sure you really get guidance before you start paying down something with that much money, because you don't want to go spend $25,000 if it's not going to truly help your credit score. So, but again, that's just one of the things out there. It's kind of a little quirk in the system. But if it's under $25,000, then you're fine, and you definitely want to make sure that those credit cards are paid down, as low as possible. So another thing that we run into, sometimes there are misreporting errors. And if you do see your personal credit report and the amount owed is blank, or it's the high credit limit is blank, which is very common with American Express, then your balance is always 100%, because there's nothing for it to divide itself into, because it's basically a zero. The bureau is treated as a zero. So if that's the case, you want to be very careful and look at those and make sure that, hey, maybe that information is not being updated properly. You can call your creditor, you can call the bureaus, and make sure that is taken care of. The next thing, closing revolving accounts. In a perfect world, you want to have between 3 and 5 credit cards. That's going to be the best. If you have 15 or 20, then typically that can really start to create problems with high utilization ratio. And if you only have 1 or 2, then you're not giving yourself enough other credit lines to really get the best credit score possible. So our recommendation, and what we've seen time and time again, is between 3 and 5 revolving accounts is going to be best. So the next piece here, and this segues back to Pat's question, the credit history. So what happens in the credit world is when you get a brand new credit card, or any trade line for that matter, the first month you have it, it starts at 1. And every single month that you have that account, it keeps counting. And it maxes out at 99 months. So what happens is, if you have that counter at 0 or 1 or less than 6, then the model says, hey, this account's less than 6 months old. This has not been seasoned. So there's a penalty involved with that. It's a new account. So what happens is, your credit score, when you get a brand new credit card, typically the score will go down for a little while, and then it'll start to go up after that account seasons. So what you want to make sure of is that that account is seasoning. And the worst thing that somebody can do is get a brand new account, use it one time, put the credit card in the drawer, never use it again. That counter will always stay at 1 or 2, and it just stays there. So the model always thinks you have a brand new credit card. So it's very important to use it once a month, pay it off, use it, pay it off. And that way that counter keeps going. And then that's how you establish these long-standing trade lines that have a long positive history. So that's very important. One other thing I want to add as far as the balances go, the bureaus take a snapshot. So, you don't really know when that snapshot's going to happen. So if you do have that $1,000 credit limit, and let's just say you buy a TV or something today, and it's $700. Well, even though you may pay that off next week, if that snapshot is taken today, then the model thinks, hey, you have a $700 balance, 770%, so you're going to take a hit on that. So you want to make sure that at any time during the month, you're keeping those balances as low as possible too. And especially if you know you're going to be making a big purchase. If you're going to buy a car in January, then you want to make sure right now you pay all those credit cards down and you leave them down. Because even if you put a little bit of a charge on it and you think you're going to pay it off, and you do pay it off, if that snapshot is taken before you do it and that's sent to the bureaus, then it's going to look like you're a lot more in debt than you really are. So it's kind of like the movie reels, and each picture is just a snapshot in time. So you have to be careful with that. We typically would not recommend closing an old credit card because of the reasons I just discussed with that counter. If you have a 99-month-old card that's sitting there, that is really helping your credit score. So the last thing you want to do is close that and then open up or have your next oldest card something that you just opened up 6 months ago or even a year ago. So keep your old ones open, use it once a month, and make sure, again, to Pat's point about closing, you don't want to have the creditor close your account for non-use. So you want to be using it a little bit every single month. So the types of credit. So, typically, we have the mortgages, we have student loans, auto loans. Those are all great. We have revolving cards that we just talked about, but there's also finance companies. And finance companies are a different kind of credit, and they're just treated a little bit differently by the model. And what happens is finance companies, are typically issued only at a particular store. So think of it like this: if you can go use your MasterCard or Visa at any store, then that's revolving, and that's just the typical credit card. But if you go to a particular store, maybe it's furniture or maybe it's home electronics, and you can only use that line of credit with them, then that's typically a finance company. So finance companies, there's so many of them and they're all treated differently, but a lot of times what will happen is they won't report to all 3 bureaus, or they may report to 1 or just 2. But when we see that happen, the scores are definitely different because they're weighted because of what type of credit it is. So again, you want to be careful when you're working with finance companies. Okay, so now this next piece of the puzzle here are the inquiries. So what happened was years ago when credit scoring first came out, they would have cases where people would go, and let's just say they're buying a car, and they may go to the Honda dealership in the morning, and their credit score was a 700, and then they go, the Kia dealer, then the Honda, and Toyota, and Ford, and all that. And then by the end, their credit score had dropped because they kept getting penalized for inquiries. So what happened was there were some safeguards that were put into the system to allow consumers to shop, because it was so unfair to penalize a consumer just for shopping around. So luckily they did put a safeguard in place, which allows you a shopping period. So what happens is when you have your credit report pulled, you have a 30-day buffer to basically do that. Now it depends on the model, because there's different models out there that treat it differently. There's 14-day spans, 45 days, and 30 days. But just for simplicity, we're going to say the most common one is going to be like a 30-day window that you can have, where you can have your credit report pulled multiple times, and it's only going to count as 1 inquiry for you. So that's important to know. The last thing in the world you want to do is go apply for something, and then 35 or 40 days later, apply for something else, and then 60 days later, apply for something else. You want to try to keep them as close as possible if you are going to shop around. That way, your credit score doesn't go down. So the tips to improve a score, we kind of talked about paying down the credit cards to 30%. Of course, we don't want to close accounts that are older, and we don't want to consolidate all of our debt onto one particular credit card. We don't want to do that. Those are like the best tips right there that I wanted to highlight. The next one, I just saw another question. Shouldn't inquiries be similar, like car shopping? Yes, that is absolutely true. On our end, the permissible purpose is, mortgage companies or cars or credit cards. So yes, you want to stay inside the particular category. So, all car shopping or all mortgage shopping or all credit cards. That was a really good question. And is there another question we had here? No, okay. Okay, so we'll go to the next slide here. Oh, okay, another question that just came in. Settling a debt hurt your credit score, or is it better to pay the balance in full? So this is a very good question, and it's going to depend on each circumstance. But when you have something that's outstanding and you owe money, then you need to find out what the backstory is. So typically, like, let's just say we see a lot of it happening with medical collections, or something that happened during COVID where somebody thought there was a forbearance, but there wasn't. So the first thing we want to do is find out, hey, is this legitimate, or was there a miscommunication, or was there some kind of problem? If there's some kind of problem, then what we find, it's best to contact the creditor that's reporting that trade line and ask and say, hey, look, we thought our insurance was covering this, it didn't. Can we negotiate? We will pay this, but we want to have it removed from our credit report. Once it's already been paid and time has gone by, then that becomes a little more difficult for that to happen. But you always want to ask that question if there was a legitimate reason why, why it shouldn't be on your credit report. So you can have that discussion with your creditor and say, hey, look, we never knew about it, or our insurance was supposed to cover it. We understand now we owe you the $75 or whatever it is. This is hurting our credit score. So can we get a deletion letter showing that the collection or the late payment or whatever it is comes off, and then we'll pay you right now. So if you do it that way, then no, it won't hurt your credit score. You'll pay it, they'll remove it, it'll be deleted, and you'll be able to move on. That's the best case scenario. If not, then typically what happens is the fact that the collection's already on your credit report, you've taken the hit for it. So whether or not it's paid, if you're just paying it and not removing it, then most of the time that's not going to help or hurt your credit score. It's because you've already taken the damage because it's on the credit file. So, to answer the question, there are some cases where we have seen that paying a collection does help the credit score, but the lion's share of the time, just paying it won't do anything. You need to have it removed and paid for it to help your credit score. Let me go ahead and so another question, if you are on an account with your spouse and you come off, will it affect your score? Yes, it will. And it can go both ways, because sometimes we have, situations where somebody's on as an authorized user, or maybe it's their account too, and there's a very high balance on it. So the mortgage company will say, hey, let's remove this person as an authorized user, because we don't, we're just doing the loan just in one person's name. And the credit score will go up because that huge utilization is gone. So that can be a huge help. Other times, if somebody has a thin credit file, maybe they just came out of college or school a couple of years ago and they don't really have that much credit, but they're on somebody else's account. It's a good, 99-month-old account that's had a perfect payment history and the balance is low, then that can help. So, yes, by removing yourself, that could hurt. So it really depends on the situation and what you're trying to accomplish. And of course, if there's any derogatory information on that trade line, then of course that's going to hurt. if you're added to it. And if you can get off of it, then that's going to be the best case scenario. So let me see if there's any other account. Okay, that was the question right there. So what we want to talk about now is, okay, so to make sure that you're putting your best foot forward with the highest credit score possible, you want to make sure that you're reviewing all of your accounts for accuracy. And there's two basic ways to do that. Number one, if you are going to be working with a mortgage lender, then they can do it for you. You can go to them, apply, and they'll pull your credit and walk you through all that. But if you're not going to do that, and you just want to just periodically just check on your credit, then a great place to go is annualcreditreport.com. And that'll be, I know that they're going to put that in the notes, and you'll have access to that later on. But that is a free site, and it's mandated by the federal government that once a year, every consumer will have access to a free copy of their credit report at each of the bureaus. So some people like to go in and they do, all three bureaus every January. Or other people say, I'll do Equifax in January, and then I'll do TransUnion in April, and then maybe Experian in August or September or something. So they kind of spread it out. But the point is, you want to go in and look at your credit file and see what's in there. And if you go to annualcreditreport.com, they have tools where if something's wrong, you can dispute it, and there's a mechanism to get that corrected. But you just want to look at that general information, make sure it looks right, make sure your information's right, your name, your address, all that stuff. Very, very important to do that periodically. So if there are problems, you can address them now, as opposed to, the first week of January when you're all excited to go buy that new car. You don't want to find out about it then. The next, it sounds simple, but I'll say it. It's, always make the payments on time. And, a big question that I get a lot is, when am I late? What happens? When can I truly be marked late? And the answer to that is, let's just say you have a credit card that's due on November 1st. So you don't pay it. And let's just say on November 5th or on November 15th, the credit card company says, hey, you're late. We're hitting you with a $30 late fee. They can absolutely do that, and you're late in their eyes. But they can't report that late to the bureaus until it's been a full 30 days. It's really been a full 30 days past the November 1st. So what that means, a lot of times people get frustrated and say, oh gosh, I've already been late and paid my late fees. I'll just catch it up next month. You don't want to do that. You still want to go in and pay it as soon as you can, because even though they've assessed you that $30 late payment and you're late in their eyes, you haven't been late with the bureaus yet. So you have until December 1st to still make that payment. And if you do it November 29th, then you're in great shape. Yes, you'll get hit with the $30 or whatever it is late payment, but it won't hurt your credit score. So that's why you always want to make the payments on time, or as close to on time as you possibly can. And, again, that can kind of go with the past due balances. You want to, again, we talked earlier about how you have to be careful with that. But, you want to examine each one of those as well. You want to make sure you limit your revolving indebtedness. And that's, the 30%, 50%, 70% that we talked about. I'm going to stop real quick for a question, because it looks like we have, okay, so we have, what's the difference between a credit score or a FICO score? Great question. There are a lot of different names that are floating around out there. You'll hear FICO score, you'll hear Beacon score, you'll hear Vantage score, all kinds of different scores. And that just comes down to the different models that they're calling it, and they're looking for different things. So they're all they're all the same, because they're all producing a 3-digit number for you, but they're not all calculating the exact same way. And, for example, like that medical collection that I mentioned earlier, on the new Vantage score, medical collections don't count against the consumer. Whereas on the mortgage credit scores that we use in the mortgage industry, medical collections still count. So, that's one of the nuances of the different scores. Other scores have different buffers for how long you can shop, in different weights of how much different things are going to count against you. So a lot of moving parts there. Is Credit Karma credible? So Credit Karma, and there's a lot of other sites out there. Yes, they do what they say they're going to do, and that is they give you a free copy of your credit report. But they also, how they make their money is they have other services that they want to try to sell to you. So a lot of times when you go in there, they're going to try to, push you toward their credit cards or their particular lenders. There's nothing wrong with that per se, but you just want to be aware that that's the reason why they're giving it to you for free is because they're trying to get business elsewhere, as opposed to the annualcreditreport.com, which that is truly a free service mandated by the federal government, where the bureaus have to give you that information. Now, when you are inside of Annual Credit Report, they can try to upsell you on buying a credit score and stuff like that, but they have to give you your raw data free at least once a year. Okay, so someone said call and have the late fee waived, not used. Yes. So one thing that we find right now is that the best thing you can do if you do find yourself in a problem with a late payment or something derogatory is to communicate with your creditor, especially with COVID, everything that everybody went through with COVID and the confusion with a lot of different things with, some loans were in forbearance and payments were made, payments weren't made. There's a lot of goodwill out there right now that can be capitalized on. So you want to make sure you're reaching out to your creditor saying, hey, we thought this was in a forbearance that we didn't have to pay. And there was a miscommunication. Can you please give us some goodwill and some grace and remove this late payment for us? And a lot of time, again, it's up to the creditor whether they'll do that or not, but at least it's worth calling and asking and laying out, why that particular event happened. Now, if you've had, 20 late payments with this creditor in the last, 3 years, then they're probably going to say no. But if it's a one-time event and they see you've been a customer for years and it's just something happened, then a lot of times they are willing to work with you, and at least bringing that up, I think, can go a long way to try to help your credit report, especially as we talked about earlier, how you can take a huge hit for something like that and can throw you in a whole different bracket as far as qualification or interest rate. The next question we have, once a medical bill goes to collections, should you pay them off? And if so, why? So typically what will happen with a medical bill is that it will sit there for the full 7 years. So the question is, do you want to have it sit there the whole time and just wait for it to disappear, or get written off or whatever, or do you want to try to just get it resolved? So it's going to depend on the case by case. If it's a medical bill and you legitimately thought your insurance was covering it, and there's a story that you can tell that creditor and say, hey, here's why we thought this, here's why you weren't paid, we're totally willing to pay you now. Can you please give us some goodwill and give us a deletion letter to have this removed off our credit report, and then we'll pay you right now the $50 or whatever it is. A lot of times, if you can negotiate it that way, that's going to be your absolute best course of action. So that would be why I would say to go ahead and try to initiate and paying it right now, is so that you can try to capitalize on some goodwill and get the deletion so it's removed off your credit report. And let's see if there's any other questions. Okay, I don't see any more right there. But we're going to go on to back to the tips, and that's the last one there is joint accounts with a spouse. And why we say that is that, first of all, it's very important for everybody to understand that, if you co-sign or you're a joint, it's just like it's yours. There's really no differentiation in the eyes of the creditor and the legal aspects of collecting debts. So we see it all the time where somebody, has a credit report and they think they have a high score, but they don't. And they're like, hey, this Ford Motor Credit's not mine. And after we do a little more digging, we realize that they co-signed for somebody, 3 years ago. And of course, they had a late payment or 2 late payments. So you have to realize anytime you co-sign or you're a joint, it's just like it's yours. So with that being said, we want to make sure that, if there is a problem, if you and a spouse have everything the same, let's just say you guys, 2 people have 2 credit cards that are the exact same and they're both on it. Well, let's just say the credit card company messes up and there's a late payment. Well, both people are going to get hit and have a lower credit score. If something gets stolen, they're both going to have a problem trying to, put the card on freeze until they can get it reworked and all that. So while it's okay, of course, people want to have a joint card for some reasons, like maybe it's points or maybe they want to do it for convenience. It's also so important to have credit in your own name, all by yourself, so that in the event something like that happens, you can fall back on your own credit card that has nothing to do with anybody else, that is not late or hasn't been frozen because of theft or being lost or something like that. So very, very important to understand that. And also to hit the point home again, make sure if you co-sign for somebody, you realize that it is your debt, and you want to make sure that you have access to that account and that you're checking on it every month to make sure that it's being paid on time every month. So let me see if there's any other. So with that, I guess at this point, I want to touch on 2 other things here. The credit freeze. And I'm sure, a couple of years ago with the security breaches at the bureaus and everything, a lot of people heard about putting a freeze on their credit report. And I want to make sure everybody knows that is something you can absolutely do. Go to the credit bureaus, the website, and put a security freeze on it. And what that will do is when you set that up, you'll get a special PIN number that you'll have. And that later on, if somebody tries to access your credit, they'll be blocked. They won't be able to take credit out in your name. If you decide you want to actually apply for credit, then you'll go in and unfreeze it and give a lender access to that. So that's one thing right now that's, it's in the news. It's a pretty big deal that it does exist. It's a protection for you as a consumer to have that ability to freeze your credit report, especially if you feel like that your information was compromised in some way. Maybe you lost a document or maybe, whatever. There is a mechanism for you to lock down your credit by doing a credit freeze. The next piece is opting out. Now, a lot of times, you may get your mail and you may see all these offers that come in. How that happens is the bureaus, they have all this information on you. So what they'll do is they will sell that information. So they may sell it to, Capital One may say, hey, we want everybody in Norfolk, Virginia and Virginia Beach that has, a particular credit score or has a mortgage or doesn't have a mortgage, whatever criteria they want, they can buy those lists and then they can go and send you a direct mail solicitation. Some people like that and they want those solicitations. Others don't because they feel like it may be a security risk if someone else gets a hold of it and sees what they're applying for or can use their application. So there is a way that you can opt out of that. And they'll put it on the chat here, but it's opt out pre-screen. You can opt out of those pre-screened offers, or you can contact the bureaus and remove yourself from that so you're not going to be solicited to those different things. There it is right there, opt out pre-screen.